Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Daniel Lam, your host for the podcast. Over the last 10 days, many were saddened by the passing of the Queen. To me, it came as a complete shock, having seen Liz Truss meeting the Queen a few days before the sad news came. Many are going to miss the sense of duty that the Queen represents, but they will have to slowly get used to the world without her. In finance, the shock value would usually result in the biggest moves. As the shock sinks in, investors would begin to adjust their expectations and get used to the new paradigm, resulting in more normalized moves in the ensuing trends. Let's take a look at the VIX index, which measures US equity market volatility. Now, one of the most perplexing phenomena about last week's move in US equities was the very muted reaction in VIX, given we had the biggest one-day drop in S&P 500 over the last 2 years. VIX only went from 23 to 27. Now, back in the first half of this year, we saw the VIX hitting 37, 4 times, a full 10 volt points higher than what we saw last week. Now, translating that to layman's term, VIX at 37 means an expectation of 2.25% daily move in S&P 500 versus 1.6% daily move implied by VIX at 27. So why do we see such a relatively low market volatility this time around? Well, investors have gotten used to this inflation paradigm. Yes, the latest US CPI print was above expectations, but it was an incremental bad news for risky assets. If you look back in time, at the end of 2021, markets were expecting 325 bips rate hike for the entire 2022. So we really saw the shock value of inflation at work back in the first half of this year. Now also, equities positioning is very light. It is at 10th percentile for systematic and discretionary funds. So in layman's terms, investors who would like to get out of equities have gotten out already. So when this CPI print came, there was really little inventory of equities to sell, and volatility is not likely to persist if there were no follow-through selling. So does that mean that everything is in the clear again? Well, unfortunately, it doesn't, although the most nervous moment in the markets may be behind us already. In such an environment, we must emphasize the importance of having a barbell approach, and you should be balancing your portfolio with both income and growth exposure through assets such as high dividend equities and DMIG corporate bonds. That's all from me today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.